Welcome to our deal analysis section of the underwriting education for our investment masterclass. Deal analysis is important to really understanding the airworthiness or the acceptableness of a deal. And I like to figure out this very quickly when I'm looking at opportunities, especially when I have lots of opportunities to look at during the day. So I'll start with a little joke. Everybody thinks that they're a conservative underwriter and investor. Everybody says that. And so I hope that by the end of this training, you walk away and know when you can kind of smell the BS meter, so to speak, on that. And I'd also like to say that my journey of underwriting has not stopped. When you look at the Dunning-Kruger effect, a lot of people think they know underwriting right when they learn a little bit, but they realize later on they're peak amount stupid because there's a ton of information that you get from gaining the competence of underwriting and experience of going out, underwriting deals, seeing if they work, buying investments, comparing your underwriting to how you projected the deal to do, and really getting that growth in what you need to know to underwrite a deal in the way that it hits target returns the best. So my hope is that this presentation will just give you some of the 5 things that I look at to try to make sure a deal makes sense before continuing on and spending too much time on it. So first of all, I like the philosophy, if you're spending a lot of time on the math, it's probably not a deal. So what I mean is figure out what your kill metrics are on a deal. Maybe the deal is something that you just found in your backyard and you're trying to make it work and you're trying to force it on yourself. Well, let me give you consideration. You want to increase your deal flow to increase your no flow. So if you're just looking at one deal a year, you're probably going to spend a lot of time to try to make it work. However, when you look at our team, we look at over 1,000 deals a year, and maybe we'll buy 45 of those. And there's countless trips to the property, countless due diligence trip, countless feasibility trips that you go spend time traveling on that actually don't work out. And that's okay because you're trying to increase the number of deals that you look at, make offers on, and consider so that you can find the best opportunities in your market or in the markets that you're looking in. So I like to say, before you go out there and think you're going to buy everything that comes your way, increase the deal flow to the extent you can and get to know as fast as possible. You want to be looking at these deals and you want to know what kills it based on your investment thesis as fast as you possibly can. And so consider if you're buying like a rental property, let's say you're coming from a residential background or you buy cash flowing rentals, there's this thing called the 1% rule. And this is just a heuristic that some investors use to consider if they should buy a rental property. So let's say you have a $100,000 house. The 1% rule just means that you should expect to earn 1% of that purchase price in monthly income or monthly rent. So if you look at a house and somebody says, hey, I've got this $100,000 house and it produces $700 in rents, you can very quickly move on from that investment opportunity without looking at it much further because you have set the standard to be 1% or the 1% rule. And so this increases your ability to look at more and more and more opportunities till you find the ones that make the most sense. So in self-storage, here's a heuristic that we use for ground-up development. Now, this is actually gotten more conservative as building costs have increased, but just consider the example. We look at $15 per year rent required to build a ground-up facility. So if somebody comes up to me and says, I got this awesome property, it's awesome, the land is right on the main road and the rents or the population growth is amazing and everything is going really well, and I'll say, well, what are the rents? If they're not at least $15 per year, I'm not going to do the deal and I'm not going to spend any time on it. And this increases my time and increases my ability to go find more deals that might fit the correct criteria. So again, come up with your kill metrics quickly. Now, what does $15 rents per year mean? A 10 by 10 would basically have to be achieving $125 a month multiplied by 12, and that would be $1,500 a year. If you took that $1,500 a year and you divided it into the square footage of a 10 by 10 unit, that would be $15 rents. So if somebody came to me and said, hey, I've got this land and I want to build storage on it, what do you think? I would simply pull up market data and see what people are charging for a 10 by 10. And if it wasn't north of $125, I would tell that investor to walk away from the opportunity. And I just know that because I've done the underwriting and I've done the analysis to know that if the rents are below that, it's not going to be a justifiable project because construction costs are such that are going to really make that deal thin margin. So it's just a very quick way to kind of understanding an opportunity and if it makes sense or not. So we talked about underwriting and we talked about having a model that you can use to go through this. And, we talked about the inputs that go into your underwriting file, how it processes the information, and how it produces the results. And really, I want to stress on this segment that garbage in, garbage out. So if you have bad data going in, if you're just guessing at the rents, if you're just guessing at the sales tax, then the spreadsheet or the underwriting file is just going to spit out guesses. It's really not going to be as accurate. So in analyzing a deal, your analysis is as good as your data, as I say here. So make sure that your data that you're getting is solid and strong and comparable. And we'll get into that as we go through the courses. And as a reminder, these are all the things that you need to build an underwriting file and where you get that good data to input into your tab. Now, I have a background as an airline pilot, and this is a great opportunity for a story. I only have 45 minutes to make a decision if my aircraft is airworthy to take off. And I have to do 4 to 5 flights a day. And I have a paperwork that's like 300 pages long. And I have to go through all that paperwork and ascertain if the airplane is airworthy, if we have enough fuel, if the weather's okay, if the passenger count, the weight and balance, and all other things that might be out of service aren't applicable to my flight that would jeopardize me from getting to my destination safely. So I have to come up with a methodology to scan the paperwork and find anything in the paperwork that would otherwise deem the airworthiness of the flight unfit to move forward. Underwriting is no different. You should be able to come up with a scan process to see if there's anything in there that cause you a yellow or a red flag that wouldn't allow you to continue analyzing the investment or move forward with an opportunity. Here's how I do it. So I like to look at the annual P&L, which I spoke about in the previous opportunity or previous educational slide. And the first thing as I go from the top of the revenue and I work my way down through the expenses. And here's the 5 things I look at. Number 1, I look at year over year gross operating income growth. So in this case, year 1, 339 to 448. My question is why? Why is that P&L showing that rent growth is going to grow that much over a 1-year period? What is the business plan? What is the experience of the operator that is operating the investment? Or what is the experience of the sponsor or the property management company? And then I ask, is that market rate rent growth? Meaning that is the operator assuming the rents are going to increase in the market, which they don't control? Or have they said, hey, I'm going to add additional units to the facility, or I'm going to raise rents to market and add value to the facility? Then I look at and consider the occupancy assumptions for the investment. When you buy a self-storage or buy an opportunity, there's typically friction that takes place at the onset of the investment that you have to consider in your underwriting model. Then I say, has the operator done this before? Are there heuristics? Is there market data? Is there historicals that would otherwise prove that this investment can do this? And after that's done, I check the box and say, okay, I'm comfortable with the gross operating income assumptions on the investment. Then I look at the insurance. Is insurance going up or going down? And did you get a quote? Did you call a AAA or an A-rated insurance carrier that is familiar with the asset class that you're borrowing from? So in this case, self-storage. Have you looked and seen their previous work? Or do they have a portfolio of insurance that they put on self-storage? Are they an experienced insurance broker for what you're looking at? And have they considered the survey or the FEMA flood map to see if it's in a flood zone? And insurance is going up. Whether we like climate change or not, or disagree or agree with it, the reality is that we're having more weather events than ever before, and insurance premiums are only increasing. So you can see here, I like the operator has increased their insurance premiums year over year over year. I like that. So after the insurance checks the box, I look at the property taxes. Now, property taxes surely aren't decreasing. They're actually going up. And there's a lot of municipalities that are out for blood to try to raise the assessed value of your facility and thereby raise your assumed property taxes. We like to see the property tax assumptions double during the hold period. So you can see here, it's just a little bit shy of doubling in the fifth year from $18,000 to about $34,000. That's a conservative estimate. We like that. Then we like to look at the market and know that the mill levy rate was considered. And if you don't know what that is, then you should know what the mill levy rate is, and you should look in your market at the tax assessor's office to see what the mill levy rate is for your jurisdiction, and then apply the multiple against your property tax assumptions. Remember, when you buy the property from a seller and it's more than what the seller paid, and the county gets wind of that purchase price, there's a likeliness that you'll be reassessed 18 to 24 months into the investment, or maybe even in the first year, and that will increase your property tax payments. So you can see here, year one, we're assuming that there's probably not going to be any reassessments, but in year two, the county is going to come around and assume that our property taxes will increase with that $32,000 in the budget. I always double them, and we also have to account for the sale, meaning that when we sell the asset, the buyer is going to do the same thing to us. They're going to say, hey, well, when I buy your property for more than you paid for it, I'm going to get reassessed, which means my cash flows are going to go down and my valuation thereby is going to go down. So you got to consider that when you are building an underwriting file. That's property taxes. The fourth thing I look at is EGI, expense to gross income ratio. And is that excessive? So expense to gross income ratio, for starters, is all the revenue minus all the expenses. So you take the gross income in year one of $339,817, and you divide that into the operating expenses of $137,302 down there at the bottom. And that's a 40.4% expense to gross income ratio. That means that for every dollar that I'm making in revenue, it's going to cost me 40 cents to operate or to expend to make that dollar before debt service. So in the self-storage space, 35 to 45% is pretty typical for an EGI. The two most wild cards that will impact EGI, make it excessive or make it even a little conservative, are property taxes and insurance assumptions, because those change market to market more drastically than anything else. Office supplies are office supplies in pretty much every market, right? That expense isn't going to change all that much. Payroll and fees, might go up a little bit in more expensive markets, but property taxes and insurance can vary wildly in your investment. So those are kind of the two places I'll go back up and look if I think the EGI is excessive or not conservative enough. So 35 to 45% is pretty typical in the first year. So you can see this investment is right at 40.4. So I like that. And that's a good number for the self-storage space. The next thing is, consider what's the standard for your asset. So if it's multifamily, maybe that might be a little bit higher. If it's assisted living, much, much higher, and so on. So 35 to 45% for storage. And I always like to say, you're not special. You're not doing anything at this property that any other storage operator probably wouldn't do. Maybe you're a little bit more efficient on marketing and advertising. Maybe you're a little bit more efficient on payroll because you're operating the facility yourself. But at the end of the day, your EGI is going to be 35 to 45%. Stop kidding yourself on how low that can be. So I look at that, and then I look at cap rate. Now, I'm going to have a whole section on cap rate because cap rate is more complex than you may think. It's also pretty simple to understand if we build up your knowledge in it. So you can see that the cap rate in this investment increases, thereby decreasing the valuation prospect of the investment. So it goes from 6.13 to 6.25 over the hold period. Now, this is market rate cap rate. This is what we think the market will be willing to pay based on the income of the asset. So we're saying that we're conservatively estimating that every year the market is going to be willing to pay less for the storage facility. This is what I like to see. I like to see the cap rate getting more and more conservative over the hold period. So I like this. Now, in today's market, and I'm speaking in 2023, I like to see the cap rate going up, obviously, but in this market, I want to see that cap rate increase from 50 to 100 basis points. We're in times of uncertainty. You don't know where cap rates are going to be in a year or two or three or four or five. So I like to see that go up as an ounce of conservatism to make sure that the underwriting is solid and that the numbers are good when I'm looking at what I'm going to expect as an investor in the deal. So we hope you found this enlightening and educational. On to the next section.